we continue with the introduction to portfolio analysis. So far, we've done the introduction, we've done expected return, standard deviation, relative risk of an individual asset, the expected return of a true asset portfolio, the covariance and the correlation coefficient of returns of assets. Today, we move to the actual risk of a true portfolio using the analytical and mathematical model and its interpretation. Portfolio risk, the actual portfolio risk. Now, the portfolio risk is the potential for the value of an investment portfolio to fluctuate. Portfolio risk is that simple, candidates. Portfolio risk is the potential for the value of an investment portfolio to fluctuate, which may lead to losses or reduced returns. And it encompasses the uncertainties and risks associated with the various assets within that portfolio. Within that portfolio. So this is a portfolio risk. Let me write it here. Portfolio risk. I've defined it as the potential for the value of an investment portfolio to fluctuate. Is the potential for an investment portfolio to the value, potential for the value, potential for the value. We have value here for the value of an investment portfolio to fluctuate. And the value of a portfolio can fluctuate because of many factors. Factors contributing to portfolio risk. Why would the value of an investment portfolio fluctuate? That is fluctuating from the expected value. One obvious reason is the market risk. Market risk can contribute portfolio risk. Now, market risk is the risk associated with the overall market fluctuations, such as the interest rate changes, the inflation rates, economic downturns, and so on. These are risks that affect all businesses in the market. That can reduce the value of an investment portfolio. 2, systematic risk. This is the type of risk that affects the entire market and cannot be completely eliminated through diversification. We have the unsystematic risk. Systematic risk, candidates, is a risk that is specific to the individual assets within a portfolio. And systematic. And such a risk can be reduced through diversification. 4, liquidity risk. Now, liquidity risk arises when it's difficult to buy or sell an asset quickly without significantly impacting its price. There are times when as an asset, it can be a share or a bond or any other asset. Sometimes it may be difficult to sell that asset. If one finds it difficult to sell an asset, to liquidate an asset, then that is what we are calling liquidity risk. It arises when it is difficult to buy or sell an asset quickly. There are assets that can be sold quickly, others cannot be sold quickly. An asset that you may find difficult to buy or sell has a high liquidity risk, and that affects or contributes to portfolio risk. Because remember, I said that a portfolio is a group of assets. If there's an asset within that group that has a high liquidity risk, then it contributes to the overall portfolio risk. 5, credit risk. Now, credit risk is the risk associated with the possibility of default on debt obligations, such as corporate bonds or loans. Currency risks. Number 6, currency risks. These are risks that arise from fluctuations in the exchange rates, which can impact the value of international investments. You understand? I have not seen this question being tested before. Factors contributing to portfolio risk: systematic risk, unsystematic risk, liquidity risk, credit risk, currency risk. You understand? So then, candidates, in a two asset portfolio, the overall risk or the portfolio risk is not simply the weighted average of the individual asset risks. This risk, candidates, is influenced by correlation between the two assets. So portfolio risk is something I've said very important, candidates, that I repeat, that portfolio risk in a two asset portfolio, the overall risk is not simply the weighted average of the individual asset risks, as it is the case for portfolio return. We will call the portfolio return, we said that the portfolio return is the weighted average of the individual assets within that portfolio. But for a portfolio risk, it is not just the weighted risk. It's also influenced by the correlation between the two assets. So portfolio risk is equal to, that is the abbreviation for portfolio risk, will be then equal to the square root of the weight, let me write it here, it will be equal to the square root of weight squared of the standard deviation or the square standard deviation of the variance of A plus we square the weight of asset B times the variance of asset B. So this is standard deviation squared. Standard deviation squared is equal to the variance plus 2WA WB. Okay, we multiply, you get the product of the weights times 2. The product of the weights. So this is WA, weight of A, times weight of B, times 2. Do you see that? Are you following? And remember, I've just said that portfolio risk is influenced by the correlation between the two assets. By the correlation between the two assets. How do you calculate the correlation between two assets? Correlation between two assets. Correlation between asset A and B. Correlation between asset A and B. Okay? So we take this, the product. This is the product of the weights. Product of weight A or product times product of weight B. It could be maybe 60%, 40%. Or it could be 50%, 50%, or 30%. These are weights, or 70%. So you multiply the weights, convert this into decimal, that into decimal, you'll have 0.6 times 0.4 times 2 times the correlation coefficient of A and B. Okay? Times the standard deviation of A times standard deviation of B. So that is writing going down. I'm supposed to write this. So you see that? Weight of A times weight of B times the correlation coefficient of A and B, standard deviation of A times standard deviation of B. So that is the formula for calculating the portfolio risk. So we square the weight, then we square the standard deviation of, this is weight of, the weight of asset A. We square the weight of asset B, we square the standard deviation of asset A. Then we add the square of weight of asset B times standard deviation of asset B plus 2 times weight of asset A proportion of asset B times the correlation coefficient of A and B times standard deviation of asset A times standard deviation of B. We get the square root. That will give us the portfolio risk. Pedro Nyango, a prospective investor, is considering buying shares of company A and company B, which are currently selling at 40 shillings and 50 shillings respectively at the Securities Exchange. He wishes to invest at $1 million shillings in both companies' shares in the ratio of 6:4 for share A and share B respectively. The forecasted end of year market prices and the probabilities of their occurrence in different economic conditions are shown as follows. So during the best economic condition, probability 0.4, fair 0.3, poor 0.3. Then we have the end of year market prices 50, 42, 35 for share A, respectively 60 shillings, 50 shillings, and 40 shillings for share B, respectively, required 1 expected rate of return for each investment. Expected rate of return for each investment. The question is expected rate of return. A rate of return is a percentage. A rate of return is a percentage, and these are the tricks the examiner plays on candidates. You are too quick to multiply 0.4 times 50 plus 0.3 times 42 plus 0.3 times 35, then you got, what was it? You got 43.1%. Forgetting that the 50, the 42, and the 35, those are the end of year market price in shillings. Market price in shillings. The figures you have there are market prices in shillings. You only apply the probability on a rate, not on shillings, not on shillings. You apply the probability if you are given the rates. In this case, the rates are not provided. So there's no way you can take the 0.4 times 50 plus 0.3 times 42 plus 0.3 times 35. The 50, I repeat, the 42 and the 35, those are the returns in shillings, returns on shillings. So before multiplying the probability by the rate, you have first of all to determine the rate of return. Determine the rate of return. So return on share A, return on share A. We have the conditions, the market conditions. Give me the market conditions. Give me the question. Best, fair, poor. Best, fair, poor. We have best, fair, and poor market conditions, economic conditions. Then we have the shillings. When the economy is best, return on share A, this is MPS. Is it MPS? This is end of year market price in shillings. It is 50. Before this, we have the probabilities. Probabilities. When the economy is best, 0.4, 0.3, 0.3. Then we have the MPS in shillings. 50, 42, 35. These are shillings. So to get the return on share A, you can only multiply 0.4 by 50, 0.4 plus 0.3 times 42 plus 0.3 times 3 if these are percentages, but these are returns in shillings. So we have to first of all convert these shillings into percentage. Convert the shillings into percentage, and that will be equal to P01 minus P0 over P0, where P1 is the current price. This is the price. P0 is the base. We're going to have here 50 minus. We read from the question. Look at the first sentence there. Look at the first sentence. Freddy Konyango, a prospective investor, is considering buying shares of Company A and Company B, which are currently selling at 40 shillings and 50 shillings respectively. Currently selling. Currently selling. Currently selling is the present, is the current price, abbreviated as P naught. The current price is P naught. P1 is expected price. So the difference, we take the difference, we divide by this, then we have a percentage. So we have P1 minus P naught over P naught, P naught. So we have 50 minus 40 over 40. Then we multiply by 100 to get the percentage. Next, we have 42 minus 40 over 40. Then we have 35 minus 40 over 40. So what are the returns under the different market conditions? $25, 5%, and 12, is it 12? 12.5%. This is negative. So with that, we can then get the returns. So the expected return for share A will be equal to 0.4 times the 25% plus 0.3 times the 5% plus 0.3 times the 12.5%. Then return on share B, we do the same. We have best, fair, and poor. Probability 0.4, 0.3, 0.3. We have the MPS in shillings. MPS in shillings, how much is it? 60, 50, 40. 60, 50. This is, I shall not be here. 60, 50, 40. Therefore, the rate, so the current market price for share B is 50 shillings. So we'll have here 60 minus 50 over 50. Then 50 minus 50 over 50. 40 minus 50 over 50. To the return. The return. This is obviously 0%. So the expected return for share B, 0.3. 20, 0, negative 20. 20%, 0, 20. Is that the case? This is negative. And therefore, the expected return for B will be equal to 0.4 times 20% plus 0.3 times 0% plus 0.3 times negative 20%. What is the expected return? 7.75. This one is 7.75%. This one is 2% according to Mwangi. That is the answer for Roman 1. Roman 2, you are required to calculate the expected return of the portfolio, which we know is equal to the summation of WA the return of the return of asset A plus weight of asset B times the return of asset B. So we have the weight from the question. Look at the question. It reads that he wishes to invest $1 million in both companies in the ratio of 6:4 for share A and share B respectively. So it's 6:4 ratio, and we are given the total of 1 million. So for A, this is A and B. So the proportion or the weight for A will be equal to 6/10. 6 plus 4 is 10. We multiply by 1 million. That is the amount, but we already have 6:4. Okay, 6:4. Do you see that? So we have 6/10. So we can simply convert this without going the long route. So we are given the proportions. The ratio is 6:4. So the total here is 10. So we have 6/10 for A. This is A, B. Then B is, the proportion is 4/10. Do you see that? So it is, when converted to decimal, this is 0.6, 0.4. So those are the weights. 0.6, 0.4. So the weight here is 0.6 for share A. That proportion is the weight, times the 7.75% return for asset A, 7.75, plus weight share B, 0.4, times the return of share B, 2%. So what is the expected portfolio return? 5.45. Abraham says 5.45. That's the return portfolio. Part 3, portfolio risk. Portfolio risk. The portfolio risk. We need to calculate the portfolio risk. So we need the standard deviation. We need the correlation coefficient. So the formula, we have it on the board. This is the formula for calculating portfolio risk. You see that? This is the formula for calculating the portfolio risk. It is the square root. The weights, we have the weights. Do we have the standard deviations? No, we don't have the standard deviation. Then we need the coefficient correlation. We need the correlation coefficient between returns of security A and security B. Portfolio risk. This is Roman 3. Portfolio risk, that is the abbreviation for portfolio risk. So how we write it. Portfolio risk. So is memorize this, the portfolio risk. We get the square of weight A, square weight A. Then we get the product of this square. The product is this is W squared. Then we get the variance of A. The same thing applies for security B. We add security B, weight of security B, square weight of security B, the variance of security B plus 2 times weight of security A, weight security B. Get the product of the weights, then multiply by 2. Correlation coefficient of A and B. We multiply by the standard deviation of A and standard deviation of B. So the square root of all that will be the portfolio risk. And in a true asset portfolio, the overall risk is not simply the weighted average of the individual asset risks, because it is also influenced by the correlation coefficient. So we don't just get the weights of the standard deviations. It is also influenced by the correlation coefficient. So we need to have some workings for the standard deviation and the correlation coefficient. See that? So how do you calculate the standard deviation? Let's first do the standard deviation of asset A. Asset A, want to do the standard deviation. We have the conditions. Best, fair, poor. We have the probabilities, 0.4, 0.3, 0.3. That's the next column. The returns, return of asset A. Do you have the return for asset A? Did we calculate the return for asset A? Do you have the return for asset A? Yes, at best, 25%, 5%, negative 12.5%. These are returns at different conditions. Here they are. Do you see that? So that is our third column. Then you have RA, the deviations at RA minus RA bar minus RA bar. This is the deviation. This is the deviation. We'll square the deviation, then multiply by the probability. Multiply by the probability. So the answer we get here will be the variance. Then we get the square root of the variance to have the standard deviation. 25, this 25 minus 25 minus the expected return of asset A, 7.75%. 7.75%. 20% square it times probability 0.4. How much is it? Next we have this 5 minus the 7.75 square the deviation times 0.3. How much is it? Negative 12.5 minus 7.5, 7.75 square it times 0.3. How much is it? Give me this total. Get the values, get the totals. The conditions we have best for asset B, probability 0.3, fair, probability, this is 0.4, probability 0.3, poor, probability 0.3. Returns for asset, this is RA, returns when at best 20%, 0%, negative 20%. Then I need RB, this is RB, the deviation RB minus RB bar, get me this, the deviation multiplied by the square it, then multiply by the probability. So here you have 20 minus expected return, 2%, square it, 0.4. Excuse me. 0 minus 2, square it times 0.3, negative 20 minus 2, square it times 0.3. Give me the values, give me the total. $244.31. This is the variance. $276. So we have all we need apart from the correlation coefficient. How do we calculate correlation coefficient? Now look at the question. Look at the question. Look at the question. The question reads that the forecasted end of year prices and the probabilities of the occurrence in different economic conditions are given as follows. Roman 3 reads, assuming that the returns of share A and share B are perfectly positively correlated, are perfectly positively correlated, perfectly positively correlated, perfectly positively correlated. That means that the correlation coefficient of asset A and B is 1. That means that the correlation coefficient of asset A and asset B is 1. And someone just asked here, what is the meaning What is the meaning? What is the meaning? Lincoln asks, what is the meaning of perfectly positively correlated? Perfectly positively correlated. That means that the relationship, because candidates correlation coefficient, first of all, let me just take it from the beginning. Correlation coefficient is a measure of the strength of the relationship between two assets. Correlation coefficient. It is a statistical measure. It is a financial metric that does what? That quantifies the strength and the direction of a linear relationship between two variables. And it is a single number that ranges between -1 and +1. So it measures the strength of relationship between two variables. Here we have share A and share B. It quantifies the strength and direction of a linear relationship between two variables. So when we read that the relationship between share A and share B is perfectly correlated, positively correlated, that means that as the return of share A increases, the return of share B also increases. They move in the same direction. Perfect because candidates, if you are saying it lies between -1 and +1, if you are to draw a number line, you have 0 here, then you have 0.1, 0.2, 0.3. That will go on up to 1.0. We have here 0.9, 0.4, 0.5, 0.6, 0.7, 0.8, 0.9, then 1. Then if you go on the negative side, still you have 0.1 negative. So this will go on up to you have here negative 0.9. Then after 0.9, you will have negative 1.0. So then the measure lies between -1, this -1, +1, this +1. So the measure can be -1, it could be -0.9, it could be -0.8, it could be -0.1, it can be 0. It can be 0.1, 0.2, 0.3, 0.4, 0.5, 0.6, 0.9, 0.9, then 1. So it lies between these 2 points, So if it is 1, then it's perfect. But it can also be 0.2. This is, you see, it's positive. Positive 1 is a perfect positive relationship. If it is +1, this one. But it can also be 0.9 positive. This 0.9 is not as strong as 1. 0.3 is not as strong 0.9. 0.2 is not as strong as 0.3. So perfectly positive means as the percentage return of asset A increases, if it is increasing by 50%. The other one also increases by 50%. You may also have negative candidates, negative. Perfect negative correlation means that as one variable increases, the other one decreases, negative. Yes, so it says yes. So we read from the question, assuming that the returns of share A and share B are perfectly positively correlated, compute the portfolio risk. We need the correlation coefficient in this calculation to get the standard deviation. It has already been calculated. You are told assuming. But you also need to know the formula. If you are not given, this one, candidates who are given the correlation coefficient, all right? The correlation coefficient was given. It is 1. You need to know the formula on how to calculate, which we did in our last lesson. So let's then do this. Risk, what is the risk? Square proportion of A is 0.6, you square it. What is the standard deviation? Standard deviation is the square root of the variance, which you already have. You don't need to square it. We already have the variance. This is a variance. The variance there is 244. Multiply. Plus the weight of 0.4 times the variance, 276, plus 2 times the weight of A 0.6 times the weight of 0.4. So these we multiply like that. Then we have the correlation coefficient of 1, we multiply by 1. Then what is the standard deviation of A? The standard deviation of A is the square root of the variance of A. So give me the standard deviation of security A, which is equal to the square root of 244.31. This is A, standard deviation. Standard deviation for B, standard deviation for B is equal to the square root of 276. How much is it? $15.6, 16.6. We multiply. Then get this square root. So what is the risk of the portfolio? Portfolio risk. 16. Now, a standard deviation, a portfolio risk. The portfolio risk of 16, what does that mean? That means that the returns of this portfolio can fluctuate by 16% from the mean. It's fluctuating 16% by 16% from the mean, which is the expected return of the portfolio of 5.45%. It can fluctuate by 16 points from the expected return. The expected return of this portfolio is 5.45. So it can fluctuate by 15%, by 16%, or 16 points from the mean, which is the expected return from this portfolio.